The Thames looks calm at dawn. But beneath the surface lies the story of one of Britain's most financially engineered utilities. A company that has paid out billions in dividends, loaded itself with billions in debt, and now stands on the edge of collapse, asking the public to rescue the very system that extracted from them. Thames Water entered the private market debt-free. Its infrastructure had been built with public money. It was sold at a discount, with promises of investment and innovation. But the regulatory model contained a loophole. Companies could choose their own debt levels, even though Ofwat set prices using a hypothetical, lower level of debt. This mismatch became the engine of extraction. Between 1990 and 1996, Thames Water paid out hundreds of millions in dividends. But in 1996, the company paid a £500 million additional interim dividend to correct what it called a reserve disparity. Immediately afterwards, the parent re-injected the same amount. The accounts state that net cash flow was unaffected. This was not a dividend. It was a balance sheet maneuver. In 1998, Thames Water paid another £500 million restructuring dividend. In 1999, it paid £750 million to bring gearing in line with Ofwat's assumptions. These dividends were funded by debt, not profit. Investment fell sharply. Extraction rose. The company was being reshaped for financial engineering, not infrastructure stewardship. When Thames Water was sold to RWE, the German parent absorbed its diversified subsidiaries and began selling non-core businesses. The proceeds did not return to Thames Water Utilities Limited. They went to RWE shareholders. The regulated utility was left with rising debt and declining investment. Macquarie bought Thames Water in 2006 and introduced a complex web of holding companies and internal loans. Debt rose sharply. Dividends and fees flowed upward. By the time Macquarie exited, it had extracted £2.7 billion. Thames Water had become a financial instrument, not a water company. Underinvestment led to leakage, pollution, and operational decline. The infrastructure was hollowed out. The regulated utility became a shell supporting a leveraged financial structure. In 2025, Thames Water won a High Court battle to secure a £3 billion rescue loan from the UK government. Public money is now being used to stabilise a private company that extracted billions. This loan is not an investment in future infrastructure. It is a stabilisation mechanism. In the same year, Thames Water paid its incoming chief financial officer a £1 million signing-on fee. This was not a reward for operational excellence. It was a distress premium for managing a collapsing balance sheet. Some claim renationalisation would cost billions. But Thames Water's equity has already been written down to zero by its own investors. The law allows special administration, debt restructuring, and transfer of assets without compensating shareholders who have already extracted excess returns. Renationalisation is not a purchase. It is a recovery. Water is not a financial asset. It is a public necessity. The story of Thames Water is not just about dividends and debt. It is about the consequences of allowing essential infrastructure to become a financial instrument. The river will outlast every financial model. But the public should not have to outlast the consequences of a failed one. Renationalisation is not ideological. It is responsible. It is about rebuilding what was hollowed out. And ensuring that the next 30 years look nothing like the last. Thames Water didn't just fail, it was hollowed out. Decades of extraction, debt loading and underinvestment have left the system broken. Dyslexic Politics' 3-part report shows the evidence, the mechanisms, and how we take the utility back without paying twice.